Well, hello and welcome everybody. Thank you for joining us today for our webinar on popular real estate investing strategies using a self-directed IRA. My name is Patrick Hagen. I'm the Regional Business Development Manager for the Entrust Group. I'm operating out of St. Louis, Missouri, and I'm going to be the presenter today. And I look forward to having a few good questions from you, and I can provide some answers to you and get the information that you're seeking from this webinar. Today's webinar is an open forum. You have the ability to chat questions. Those questions go directly to me. I will periodically throughout the presentation stop to read those questions and provide an answer as it fits into the webinar. So please do feel free to type those in at any point, and I will be reading those. And I look forward to getting your questions, because the value here is that you walk away from this presentation with the information that you specifically want to get from the Entrust Group. We do have a PowerPoint presentation. We're going to go through these slides, but the main takeaway should be that you get the information that you're seeking. Today's presentation is a little bit unique. We do a lot of real estate IRA webinars. This one's less about just real estate IRAs in general and more about the unique ways that some of our clients have structured their real estate deals in the past. I'll tell you a bit about Entrust here in a moment, but we've been doing this now for 31 years. And over those 31 years, we've seen quite a few different ways to do an investment. We've seen a lot of different people structure things in very unique ways. And by watching them, and we watch our clients, and we have a lot of intelligent clients that do a lot of different unique things, we've kind of learned what some of the options are for self-directed IRAs. And we've watched and learned vicariously by watching what our self-directed clients do. Because with a self-directed IRA, the client controls everything. We simply, as the record keeper, facilitate what the clients tell us to do. So we've seen everything from real estate to private placements to private notes to some off-the-wall investments like racehorses and tractors and farmland. So it's really interesting from my perspective as somebody that works in this space to see what our clients do. And a couple of these strategies that we're going to talk about today are just things that we've seen our clients put together that work for a self-directed IRA. So without any further ado, let's go ahead and jump into it. Again, I'm Patrick Hagen. I'm with the Entrust Group. And if you have any questions at any point, please type them in. We start all of our presentations with a disclaimer. This is very important because as a record keeper and administrator for retirement plans, self-directed retirement plans, we are not an advisory firm, an accounting firm, or an attorney firm. So I'll read this to you because it's important. The Entrust Group, Entrust, does not provide investment advice or endorse any products. All information and materials are for educational purposes only. All parties are encouraged to consult with their attorneys, accountants, and financial advisors before entering into any type of investment. We'll talk in a moment here about what a self-directed IRA is and what that encompasses, but this disclaimer kind of wraps it up in that we don't fill that role. We're not a fiduciary, we're not a CPA firm or an advisory firm. We're simply the record keeper and the administrator of the self-directed IRA. Now, the benefit of that is you can invest in things like real estate, which is what we're going to discuss today. So the unique nature of the way that we're structured allows for some flexibility that maybe you haven't had in the past with your current IRA or 401k provider. So a quick agenda today. We're going to tell you a little bit about the Entrust Group. We're going to briefly touch on the state of retirement in the United States, what we're seeing from investors and from taxpayers out there that have retirement plan money, and where they're at and kind of their views on some things. We're going to talk about self-directed IRAs. We're going to talk about why a self-directed IRA can invest in real estate and how a self-directed IRA can invest in real estate. And then the real nuts and bolts of what we're going to discuss specific today is some popular real estate investing strategies. So some things that our clients have done that are maybe a little bit unique from just buying a property through an IRA as a cash purchase with one owner. We've seen a little bit of a variation in the way things are structured, and we'll talk about a couple of those today. We'll also touch on the rules related to IRA investing. These rules come out of the code, IRC 4975, and basically as an administrator of self-directed IRAs, we try to package what the code says and put it in layman's terms. So we'll talk about very simply what you can do and what you're not allowed to do in respect to buying real estate through a retirement plan, and then a couple of due diligence tips as we wrap up. Quick overview of the Entrust Group. We are the premier provider of self-directed IRAs. We've been in this space now for over 30 years. We currently have over 15,000 self-directed IRA clients, which equates to about $4 billion in investor assets. That's pretty good size for a company in our space. Again, we've been doing it about as long as anybody you're going to find, and we're a very good-sized company in relation to self-directed IRA providers. When you compare us to a big bank or brokerage company, we are not very big compared to some of the big players out there. But when you compare us to other self-directed IRA providers that specialize exclusively in these niche assets like real estate and private placements and notes, we're a very good-sized company, and we've been doing it about as long as anybody you will find. We've got a great staff in Oakland, California, as well as regional offices throughout the country. One of the things that makes us unique is that, generally speaking, your day-to-day interaction will be with a regional business development manager and or their assistant. So if you live in the Central Time Zone, you could call somebody in the Central Time Zone and get things done related to your account. Same thing in the East and out West. And so instead of doing everything centralized with just one call center and 1-800 number, we have regional offices that help not only on the front end explaining how all this works, but also the day-to-day, getting things done, to know that you can pick up the phone and call somebody that you've talked with before and get that same person to help you walk through the process, in my mind, is beneficial because it allows simplicity throughout the transaction from A to Z. It also provides some accountability to that rep that works with you because they're assigned to your account, and it's their responsibility to make sure that you're getting the service that we promise on the front end. We've got some great educational programs. We teach CE courses to CPAs, attorneys, real estate professionals, and financial advisors. We do events throughout the country, both in-person events as well as web-based events. And like I mentioned before, we've got the local offices, which at least regionally gives you someone in your time zone that you can get a hold of when you need to get things done. Quick overview of the state of the retirement in the United States. Where are we at right now? You know, retirement planning has changed considerably in the last 20, 30 years. My grandparents retired with a pension, 35 years ago. They get a check every couple of weeks in the mail. They haven't worked for 45 years, but because they had a pension, they still get that money coming in every couple of weeks. Most of us today don't have the benefit of a pension, so we're required to set aside money for ourselves through either a 401k or some kind of other tax-deferred account like an IRA or potentially a Roth. But these are a couple of statistics that we pulled, and you can see the source here at the bottom of the screen. In 1991, about 50% of workers expected to retire before age 65. 11% expect to retire after 65. Roll the clock forward to 2013. 23%, so that's more than half of the, basically half of what we before were comfortable or anticipated to retire before 65 are no longer feeling they will be able to do that. And about 36% of workers expect to work after the age of 65. Another note there is over 30% of households have less than $50,000 saved for retirement. So you look at that and say, well, what does that mean? Well, it doesn't really mean that we have answers to that. It just means it's something to be aware of. As you think of your retirement, think about it right now because, as we all know, time moves pretty quick. And someday you're going to be 65 or 70 or 80, and you need to plan today so that you have answers and solutions when that time comes down the road. What we're going to talk about today is kind of a unique structure of buying something alternative through your retirement plan. So if you have an area of expertise in real estate or some other alternative investments and you want to build up that tax-deferred wealth using those alternative investments, that's something that we can assist with as a self-directed IRA provider. So that brings us to the next point. What is a self-directed IRA? This is something that we do every day, and I think it's important to step back sometimes and just explain in clear terms what a self-directed IRA is. And it's a plan that is self-directed. It's a plan that's controlled by the client that then can be invested in alternative investments. And let me explain why that's the case. Typically, when you have an IRA or a 401k, the standard model is to have that IRA or 401k with a bank or a brokerage firm. Most banks and brokerage firms can hold retirement plans. Back in 1975, when IRAs came on the scene, it was the big banks and the brokerage firms that branded themselves as IRA and 401k providers. They did that because they knew that eventually there would be quite a bit of wealth built up in these IRAs and 401ks, and they were correct. I think there's roughly $5.7 trillion in IRAs currently in the U.S. So a lot of money out there, and the big banks and brokerage companies want to control that money. With the standard model, you typically have somebody that provides advice as to what you should do. They take your money and they invest it for you into the investments that they think are going to build up wealth most appropriately for what you're trying to do. With the self-directed retirement plan, you are in complete control of everything that transpires on your account. I tell my clients all the time, you are the self in the self-directed IRA. We're simply the record keeper and the administrator that does what you specifically tell us to do when you're ready to do it. But this arrangement, by us not being an advisor, not telling you what to do, not earning commission off the investments, allows you to expand your investment options well beyond the standard stocks, bonds, and mutual funds. You can buy things like real estate and private stock and precious metals and private notes. These are things that have always been options, have always been good options for people that wanted to potentially invest in these types of things through their retirement plan, but they haven't had an administrator or a company they can work with to do it. Because typically if you call up your standard bank or brokerage company and ask them if they will do it, the answer will be no. Or maybe it'll be yes, however we don't like to, or yes, but it's difficult or costly, or whatever it may be. So we're set up as a niche company that operates exclusively in this space that does pretty much only alternative investments. Quite frankly, if you wanted to buy mutual funds, there's no need for an Entrust account. If you wanted to buy stocks or ETFs, you don't need an Entrust account. But if you want to buy a piece of real estate, we've been doing that and allowing clients to do that for 31 years. So we're very seasoned in that respect, and we can certainly, we have the platform in place to move that along very simply. Where you compare that to another company, it might be a little bit more difficult. One other point on this slide I want to point out is that an IRA is an IRA. It doesn't change, the self-directed piece doesn't change the essence of an IRA. A traditional IRA at its core is the same with Entrust as it is with any other bank or brokerage company. Same thing with a Roth IRA or a SEP IRA or any type of IRA. An IRA is an IRA. The distinction is how flexible is your administrator. How flexible is the company that's providing record keeping and administration for your retirement plan? And does that company allow you to invest in something like real estate? So the key is it's not an IRS limitation. It's not like the IRS doesn't want you to buy real estate. They're fine with it. It's finding an administrator that's willing and capable of holding that for you. Why would people choose self-direction? Typically it's because they want to invest in something that they know and understand. I gave a seminar yesterday in Chicago, and one of the questions was, how often do your investors buy their first real estate investment through their IRA? And I'd never heard that, but I thought very rarely. It's pretty typical that somebody has already invested in real estate, understands real estate, knows the ins and outs and feels pretty comfortable with it, and then decides they want to invest with their retirement plan rather than somebody buying their first investment with their self-directed IRA. Now you could certainly buy your first investment, but typically what I find as a business development manager is most of my clients already know what they want to do. They simply need a vehicle by which they can do it, and that's what we're providing as a self-directed provider, is the vehicle by which they, through their IRA, can invest in things like real estate, private placements, and private notes. The other piece is diversification. If you want to diversify your retirement money and you have all your money in a brokerage account, you can only really spread it out between stocks and stock-related investments. So you're not truly diversified in the sense that you have stuff in investments that are completely detached from the stock market. True diversification requires something that's not stock market related, and that could be anything you want: real estate, private placements, private notes, whatever fits your investment plan. But true diversification requires you to get some of that money shifted into alternative investments. And again, diversification is kind of built into any financial planning picture, but it's good to know that you've got other options outside of just the standard options in the market. You get the same tax advantages you would with any IRA, that being if you make investments through a retirement plan, those investments grow tax deferred. So you're not paying capital gains on each individual buy and sell. Everything builds up over time, tax deferred, and then you'll pay the taxes later in life at some later point when you retire. Of course, if you have a Roth IRA, it grows tax deferred. If you qualify, when you take the money out, it'll actually be tax free as opposed to tax deferred. Key point here is that you've got the same tax features, the benefits, that you would have with any other standard IRA. You can also leverage your real estate knowledge, use your center of influence. If you know people in the real estate market or out there on the street doing deals, you could potentially build up your retirement plan, getting in and out of those deals using your retirement plan. I'm not going to go through each one of these as far as what you can invest in, but it's important to note you got a lot of options, residential, commercial. We have clients that buy into entities, whether it be an LLC or a limited partnership. We have clients that lend money through their retirement plan, buy trust deeds, mortgages, precious metals. These are all viable options and things that we see our clients do. And again, we're not telling our clients specifically to do this. What we're doing is allowing them to do these types of things. The general client that comes to Entrust has already decided what they're going to do with their money. They just need us to facilitate it and make it happen for their retirement plan. Now, a couple of quick rules. These are important, and we try to touch on these in pretty much every presentation we give. There are some guidelines as far as who you can do business with between your IRA and these folks, and what you can and cannot do within an IRA in respect to what's called a prohibited transaction in relation to a disqualified person. And I'm going to kind of put this in a nutshell really quick, and then I can elaborate if need be, and if any of this doesn't make sense, just type in questions and I can go into it more in depth. But we mentioned before that you can buy real estate with an IRA. In fact, that's what most of our clients do. But there are some guidelines as far as who you can have transactions with and who can utilize the property that your IRA owns. And there are certain people that the IRS does not want you having dealings with. And those people, quite frankly, are your direct lineal relatives. It's the easiest way to describe it. These people are called disqualified persons, and they're people that your IRA cannot have dealings with. You can't sell, exchange, or lease. You cannot furnish goods, services, or facilities between your retirement plan and these people designated as disqualified persons. So let's look at who's disqualified. Well, first off, you are disqualified from your IRA account, which means if you own something right now as an individual, you're not allowed to sell that same asset to your retirement plan or to shift it or to move it into your retirement plan. That's called self-dealing. It's something the IRS would frown upon because they don't want you to take something that you own or control and move it directly into your retirement plan. Same rules apply to your spouse, your parents, your grandparents, your children, your grandchildren, as well as spouses of your descendants. So basically, in layman's terms, again, ascendants and descendants of yourself, your spouse, your children's spouses. So kind of draw a line north-south and just think, okay, well, my parents are disqualified, right? So that means that my mother cannot sell something to my IRA. My father cannot sell something to my IRA. Same thing with my children or my grandchildren, my grandparents. The other side of that is that these folks cannot use the property that your IRA owns, which means if you're going to buy a home near the university and your daughter is going to that particular university, you can own the home through the IRA and rent it out to kids to go to school at that university, but you can't have your daughter live in that property or rent that property from your IRA because specifically in the code it says that she is a disqualified person because she's a direct lineal descendant of the account holder. Again, spouses of your descendants are also disqualified. So if your son is married, then your daughter-in-law in that case would be a disqualified person. Your spouse is a disqualified person. So sometimes people will call and they'll say, you know, I've got a property and I want to move it into my IRA. And I say, well, you can't do that because the rules don't allow you to do that. And they say, well, actually my wife's on deed to the property, so she's going to move it to my IRA. It still doesn't work because your wife is considered a disqualified person. These rules apply to you, your kids, your parents, your grandparents, your grandchildren, as well as your spouse. So I bring this up to state that basically these rules are set in stone. They were drafted as part of the code in IRC 4975. They've been the same now for over 30 plus years. They're not going to change. And a lot of times people try to find kind of creative ways to get around the rules, and that's a bad idea. Quite frankly, the rules are what the rules are. The old slogan is you don't mess with the IRS. There's a reason why the rules are here, and the IRS wants you to follow those rules. So as an administrator and a record keeper of your retirement plan, technically speaking, we're not required to police this scenario. However, we do, to the best of our ability, look at what you're doing. And if we see something that's clearly a red flag, we will ask the appropriate questions and make sure that you're not going into a blatant prohibited transaction. If John Doe is buying a property from John Doe to John Doe's IRA, we're going to ask the question if John Doe is that same John Doe, because we don't want a scenario where we see a prohibited transaction happening. Now, at its core, you're the self-directed account holder, which means you're liable for the self-directed IRA and all the transactions that transpire on your account. So it's ultimately your responsibility. So it's good to use us as a resource. We can direct you to the sections of the code that summarize all this and the details of this. But at the end of the day, you need to understand what the rules are. It's very important that you can't do business with yourself or any other disqualified person, and disqualified persons can't use the property that the IRA is the owner of. So that's kind of that's the rules in a nutshell. The only other rules that come into the picture is you can't buy life insurance and you can't buy collectibles. But again, if you're looking to buy real estate, those issues are not applicable to you. But the code says specifically you can't buy life insurance or collectibles. So with respect to real estate, if you talk to somebody that said, I didn't think real estate was an option for a retirement plan, you can point them to IRC 4975 and show them that yes, it is. It's always been an option, and it always will be an option, at least in the foreseeable future, because it's part of what's allowed per the guidelines and always has been. So quick summary of the rules. Again, the point today is to kind of get to the popular real estate strategies, so I'm going to move forward to that. But if you have questions about these rules or really any of the overview stuff that I started with, feel free to type those in, chime in at any point, and I can stop what I'm doing, read the question aloud, and provide an answer to it. In fact, I got a question. Let's go ahead and start with the questions. I like answering questions as they come in. I got one that just popped up here. The question was, can you pool your and your spouse's money, their two IRAs together, into a single investment? And I read that question because it's funny, that's one of the first strategies that I'm going to talk about is partnering. So I'm going to push that off for about 2 slides, and then I'm going to speak specifically to that question, because the short answer is yes. You can take your IRA and you can take your spouse's IRA and potentially go into the same investment at the same time. If I was to back up a little bit, I'd talk about these disqualified persons. You really want to be careful in disqualified persons in doing transactions essentially between these people, which means sell, exchange, or lease something from a disqualified person to an IRA. On a new investment, there are opportunities to potentially partner alongside an IRA into a new deal on split ownership, and I'm going to speak to this in just a moment. But when you look at these rules, again, you don't want to go essentially crisscross with these disqualified persons. You don't want to take something you own and shift it or quitclaim deed or transfer it to your IRA. Now, if you and your IRA want to do something together on a new deal as partners, so to speak, that is allowable, and I'll talk about that here in just 1 second. So the 3 popular strategies, I probably could have done 10 popular strategies because we've seen so many different ways to structure deals. We picked 3, and they're just 3 that we think are viable options, things that seem to work pretty well for folks, but that you may not think about. You may not think that it's an option. So the point of this webinar is to kind of bring some awareness to that. So first thing to mention is that a real estate IRA is nothing more than a self-directed IRA that owns real estate. The folks in our space, Entrust as well as our competitor companies, realized years back that most people don't know you can buy real estate with an IRA, so we kind of coined this unofficial term of real estate IRA. As I mentioned earlier, an IRA is an IRA, whether it's in mutual funds or in real estate. So the real estate IRA is nothing more than a descriptive term that defines an IRA that's invested in real estate. And again, this is an option, always has been an option as long as IRAs have been on the scene. You can also do other stuff with a self-directed IRA, like I said before, real estate, private placements, private notes, precious metals, all kinds of unique stuff. First strategy we want to talk about, and this kind of lends to the question that was raised, is partnering your IRA. And I guess before I go into this, let me just kind of detail the standard IRA transaction in real estate if there's no partnership or any of these strategies we talk about. If you want to buy a piece of real estate through your retirement plan, there's basically 3 steps involved. And the first step would be to identify a self-directed IRA provider that you can work with that's willing and capable of facilitating the investment into the piece of real estate. As I mentioned before, we're in that niche business. We're in that space that only does the self-directed IRAs. The industry has grown pretty considerably in the last 5 to 7 years. So there's actually a lot of companies out there now that do what we do, but I don't think you'll find a lot that have been doing it nearly as long as we have or have the experience that we have with 31 plus years and all the assets that we have under management. So that's the first step, is find a company to work with. We hope it's Entrust, but if it's not, do your due diligence, scrutinize the company, make sure you know who you're working with and that they're capable of holding this asset for you. The second step in the process is to get some money moved to that account. Typically our clients have money in a retirement plan that they're shifting to the account with us. It's either going to be a transfer or a rollover. A transfer goes from company A to company B with no reporting. A rollover typically is either coming out of a qualified plan or is done as a distribution, and then within 60 days a rollover to the Entrust account. In any respect, the second step is to get some money that's existing in a retirement plan over to the new account with Entrust. A lot of our clients don't move their entire portfolio. A lot of our clients just move the amount of money that they need specifically to do the investment that they want to do. So if a client has $300,000 in an IRA and they want to buy a property for roughly $100,000, there's no need to move the entire $300,000 to the account with Entrust. You really only need to move enough to acquire the investment and then service the expenses related to that investment. So the first step, set up an account. Second step, transfer money to that account. Third step is to go out and find the real estate and then direct Entrust to process the real estate transaction on behalf of your self-directed IRA. So that's kind of the standard way of buying it. Most of our clients historically were buying stuff for cash, and a lot of times we saw that the IRA was the sole purchaser of the property. So when you look at the deed to the property or all the closing documents that come to our office, it would show the IRA as the owner of the investment. So if John Doe has an IRA with Entrust, the owner of the investment would be the Entrust Group for the benefit of John Doe IRA. His IRA owns that investment. And again, that's what we typically see. That's our standard client, is somebody that wants to buy a property for cash and own it exclusively by themselves within the IRA. Now the first strategy that we're going to talk about is one that involves partnering. And this would be a scenario where the IRA is going into an investment, but instead of investing in the entire investment, the IRA is partnering along with somebody else as an investor, as a split owner in this property. And this split ownership could be under whatever parameters the two partners or three partners decide they want to work under. It could be a 50-50 split, 80-20 split, 70-30 split, whatever works best for whoever's involved. Again, the nature of the investment, the structure of the investment is all determined by the client. We simply ask that the client inform us of what they've already decided they want to do and all the details involved, and then we facilitate accordingly. So with the partnering strategy, the reason why this becomes relevant is sometimes people want to buy property with their IRA, but they don't have enough to buy the property outright. So, if the property's $100,000 and you have $50,000, what are your options? Could you buy that $100,000 property with your $50,000? Well, this is one of the ways you could do it. Potentially buy a portion of that property with the IRA and then have somebody else buy the other portion of the property. Now, it's key to note, as I mentioned earlier with the Q&A that was brought up, you can technically partner with yourself and with other disqualified persons. We mentioned earlier here that these folks are disqualified people, which means you can't have deals between them. But it doesn't mean that you can't take your IRA and alongside these people make a new investment into a new property. The key point is you designate who owns what based on the cost basis of the purchase at the very beginning, and you keep that percentage split for the life of the investment. So if you're going to do a split ownership, and again, say it's 50-50 for example, everything would need to remain 50-50 for the life of that investment, which means when you buy it, it's split 50-50. When you pay the expenses, 50-50. When the income comes in, 50-50. So you want to keep everything proportionally split for the life of that investment. It's very critical. There's nothing wrong with split ownership, but it's definitely something that you're going to want to take into consideration before you go into it is what do I need to be aware of? And what you need to be aware of is you need to be very diligent about the way that you split that. Now, a couple of examples of partnering. You can partner with yourself. You could partner with a cousin. You could partner with your spouse. You could partner with a completely unrelated person that you decide to go into business with. And then there's a note that you could lease to your siblings, which is kind of got plugged in there. But technically, your siblings are not disqualified, so technically you could lease to them. Now, one of the things that comes up quite a bit with partnering actually came up last night in a presentation I gave. It was, if I buy part of the property with my IRA and I buy part of it with my personal funds, does that mean I can use it for a portion of the year because I own it personally? And the answer to that would be no. The IRA rules basically supersede all other rules. If the IRA is involved in any capacity, then you can't use that property. Even if the IRA is only a 40% owner or a 10% owner, if the IRA is involved, that means you can't use the property. There's nothing wrong with split ownership. There's nothing wrong with partnering with yourself or with another IRA or another individual. But if your IRA is involved at all, then the rules that apply to the IRA apply to the entire investment. So that means you can't use the investment that the IRA is a partial owner in. Avoiding prohibited transactions. Again, you can't borrow money from a disqualified person. You can't sell property to a disqualified person. You can't use an IRA for security for a personal loan. You can't buy a property and use it if the IRA is the owner of the property. So these rules are set in stone. They're the same whether you're a partial owner of the property or a complete owner of the property. But again, I want to paint a picture of what works and what doesn't. Taking something you own and selling it to your IRA doesn't work. That's a prohibited transaction. Taking your IRA alongside with your personal money, one partner being the IRA, one partner being you, and going into a new investment on split ownership, clearly detailed and documented, is okay. So hopefully that kind of explains scenario number one, which is partnering IRA funds. And we see this quite a bit, as I mentioned before, because a lot of times, based on the contribution limits and things, people just don't have enough to buy what they're seeking to buy with the IRA by itself. They need some outside money. They need to figure out a way to get creative on the deal because maybe there's not enough in the IRA to buy the entire thing for cash. I'm going to take a quick second before I go to scenario number two, and I'm going to answer some questions because there's some questions that came up here, and I wanted to go and make sure I get them answered. First question is, can a self-directed IRA invest in a franchise such as a McDonald's? The short answer to the question is technically yes. An IRA can invest passively into a franchise. There are rules and guidelines as to who owns, controls, and runs that company. And I'm not going to take a lot of time today because I could get too off track and we only have 45 minutes. But the short answer is, I guess, could an IRA invest in a privately held company like a franchise? Now, if you wanted to buy stock in McDonald's, because McDonald's is publicly traded, you wouldn't necessarily need to use a self-directed IRA. You could do that through a standard bank or brokerage company. But if you wanted to invest in a franchise and actually own that, you could do that through a retirement plan. It gets a little more complicated because it brings up questions of who runs the company, who controls the company, are you seeking to get employment and income out of the company, because that gets into a lot of areas that I won't cover in detail. I'd ask you to give me a call offline and we can talk about that because it's a little off topic. But the short answer is, can you invest into an entity like a franchise or a privately held company? The answer is yes, and we do have clients that do that. However, there are rules as far as who owns and controls that company that could potentially prohibit you from doing that with the IRA. And it's a good question though. Another question was raised was, can you pool money with your spouse? Hopefully I covered that. The answer is yes. If you have an IRA and your spouse has an IRA and the two IRAs want to go in together to that investment, they could do that. We could set up two different Entrust accounts. Both accounts could go into the same investment at the same time with split ownership, and everything would be documented as far as who owns what within that investment. Another question that came up here is, can you rent to, I think this is supposed to be an ex-spouse that's not living with your children. So the answer is, I guess, if my wife and I got divorced and I bought a property with my IRA and I wanted her to live in that property, could that work? I would say from a technical standpoint, yes, because she's not considered, once you get divorced, she's no longer considered a disqualified person because she's not your spouse. She's really no different than your neighbor across the street at that point because she's no longer a disqualified person. I would think it would get very hairy, in fact, potentially probably not a good idea, if, let's say, your children were living with your ex-spouse in that house, because now you've got a disqualified party, being your children, living in the property that your IRA owns. Even though a lease may be between you and your ex-wife who's no longer disqualified, that would still cause problems because your children would be benefiting and using the property, and that would be an issue. But in your hypothetical, it looks like you got an ex-spouse that now is completely unrelated to you, and you're not talking about your children using the property. And the question is, could you lease that property to your ex-spouse? The answer would be yeah. I don't see any problem with that, as long as you're not breaking one of the prohibited transaction rules with using the property or having your kids use the property. I think that'd be fine, as long as it's true divorce and that's not at the time of the rental, not a spouse. It's a good question, though. Can you rent to an employee is another question. The short answer to that would be generally yes. You could probably rent to an employee that's not a direct lineal relative. Obviously, if an employee was one of your children, that would cause issues. There could be some gray areas in respect to that employee depending on their involvement in your company and how you structure the investment, if it runs at all through your company or through an entity that you own or control. The short answer is, yeah, generally speaking, you would be able to rent to an employee. Now, if they're like a highly compensated employee in your company, they could, in theory, be considered a disqualified person. You want to be careful in that respect. But, if I own a company and I have 50 employees, and one of them's a nice young man that wants to rent my property, and I need a tenant for my property, and we agree to terms and a lease and all that, I don't see any reason why that would cause problems. As I mentioned at the beginning, we're not attorneys, CPAs, or advisors, so technically you probably want to run that by one of those folks. But the short answer is I don't see anything, unless I'm missing something, that would cause you to have issues with renting to an employee. Because again, an employee is not a disqualified person as defined in Section 4975 of the Code. Okay, next question is, can I open a checkbook account without forming an LLC? I'm going to kick that out if I could for the end of the presentation, because I want to introduce a new product that we have that's going to kind of be a middle ground between the standard model of running everything through Entrust and then what we see when people utilize an LLC, and I'll get to that here in just a few minutes. Another question that came up is, what happens to your investment when you start reducing your IRA at 70.5? And that brings up a good point. When you reach April of the year after you turn 70.5, you're required by the IRS to start taking money out of that retirement plan, assuming it's not a Roth. With a Roth IRA, you don't have required minimum distributions, but with any other type of IRA, you would have to start taking money out systematically based on your life expectancy from 70.5 on. The way that's impacted by a self-directed IRA is you want to plan accordingly. You want to make sure that you have at least the ability to get liquidity to take those required minimum distributions. Now, what we see is that generally speaking, most of our clients don't move their entire portfolio to us. Typically, the client moves a portion of their money to us specifically to buy real estate, and they leave the rest of their money in a more liquid bank or brokerage company. So when their RMD is calculated, it's calculated based on the value of all of their IRAs, but it's actually physically taken out of their more liquid bank or brokerage account. Now, if you had all of your money in a self-directed IRA and you were approaching 70.5, you'd probably want to refrain from investing all of that money in a tangible piece of real estate. You don't want a situation where all of your money is tied up in brick and mortar and you need to take an RMD, because if you don't take an RMD, they tax you on 50% of what you're supposed to take. So the penalties are very severe, and you want to make sure that if you're required to take a distribution, you're capable of doing that. Now, there's always ways to do it, but ideally in a perfect world, our clients will plan ahead of time, make sure that they can at least get to some money from their IRA, whether it's with us or another provider, to take those required distributions. Another question that came up here says, client has an ex-spouse and cousins that are friends and low income, and it's a way to help them with a modest home and equitable rent. Now that brings up a great point here, and it gets a little more into the gray areas of the code. But what this person's talking about here with this hypothetical is, can you help somebody out with buying a property and leasing it to them? And it kind of goes to philosophically what an IRA is set up to do. An IRA is set up to make investments for investment purposes so that the taxpayer at some point later in their life can equip themselves to take that money out and live off that money once they reach retirement age. You really don't want to do people favors with your IRA funds. You really don't want a situation where you're leasing to somebody because you just feel bad for them and you're kind of gifting that free house to them at a very discounted rate. You really want, if the IRS or the DOL ever come knocking, you want to be able to show them what you did within your retirement plan, show them what's transpired, show them that there's no prohibited transactions, and basically be able to justify what you've done and why you did it. And there's no hard and fast rule on that, but if market rents in the area that you own the home are $1,200 a month and every house on the block is rented for $1,200 a month and your ex-wife rents from you for $100 a month, that's going to look really strange on paper, and I don't know that I'd want to be on the other end of that conversation with the IRS or the DOL if they come asking. You want to make sure that it's basically a viable investment that you're leasing out with your best interest in heart. I mean, you want to lease it out to somebody who's not a relative because you want to build up your retirement plan. You want to do that at the best rate you can possibly do it. So when you start getting in those weird scenarios with ex-spouses and cousins and friends, technically speaking, it's not disqualified to lease to one of those people, but you want to do everything at fair market value because you want to be able to show that you did this not to help them out, but rather to build up your retirement plan wealth using a retirement plan invested in real estate. So got a little off track there, and maybe it's not good to talk about those details in a recorded call, but I think it's good to get the answer out there. And if you want to talk more in detail about that, having somebody local that you can call regionally to ask that type of question, we can kick that around and kind of go through the details. And again, when you deal with the IRS, you're looking at the code that was drafted 30-plus years ago that doesn't go into minute details as far as exactly what you can do and how it works and what you can't do. What they do is they say you can't self-deal, you can't buy life insurance, you can't buy collectibles. And then they fill in the gaps on individual rulings or court cases or even maybe in some cases private letter rulings. But you want to look at it holistically and see what would the IRS potentially take issue with and then not do those things that they may take issue with. So good question though, thank you. One other question and then I'll move forward. The question here is, at age 70 and a half, are you saying that you can use rents as current income as long as the taxes and distributions are paid from a different qualified source? I think what you're saying there is if you own a property and you're 70 and a half and rental income's coming into the IRA, could you take that out as a distribution to satisfy your required minimum distribution? And the answer would be yes. The other option is if you have an IRA with Entrust and you have an IRA with another provider, you could calculate your RMD based on all of the accounts, but you could physically take it out of your other account if you wanted to. You don't have to take it out proportionally from each one of your accounts. You could leave your Entrust account intact with the real estate untouched and take your RMD requirement from one of your IRAs with another company if you wanted to. That's all up to you and your planning. Good questions. I appreciate it. Thank you. And hopefully it's okay with everybody that I stop in the middle because, again, I want the questions. I want you to walk away from this with the information you're looking for. I don't just want to talk at you for 45 minutes. So thank you for that. I appreciate it. One other point as far as partnering before we move to the second scenario. Sometimes partnerships are done through joint ventures. An entity is created, an IRA buys into that entity along with other investors, and then the entity buys the actual investment. It may be an LLC. It may be some other kind of joint venture type structure, but sometimes instead of seeing a deed specifically itemizing who owns what, the IRA will go into an entity which then will go out and buy the property. So in our case then what we get from the client is direction orders to take the money and put it into the entity, into the joint venture, and then the individual investments are done through that joint venture. And we see that quite a bit. Investment strategy number 2. And again, we talked about the basic way of buying real estate for cash. We talked about split ownership. One of the things that's unique to real estate, and I think it's intriguing, is that you can buy real estate and use debt to acquire that investment. This is something that's pretty well unique to real estate. If you want to buy, if you have $100,000 of cash in an IRA and you want to buy stock, you're limited to $100,000 worth of stock. You can't leverage that investment through a bank or a brokerage company to buy more stock. It's not an option. But with real estate, you can technically put up a down payment from a retirement plan and leverage the balance of the purchase portion. So this is done through what's called a non-recourse loan. And let me explain what that is very briefly. Typically when you go out and you acquire a loan from a bank to make an investment, that bank is going to require that you personally guarantee that loan. Essentially you promise to pay the bank back is what a personal guarantee is. With a non-recourse loan, the bank would be lending to your retirement plan, and you as an individual would not be personally guaranteeing that loan. So the bank is looking at the deal and saying, I'm lending to the IRA, and my collateral is the property that the IRA is purchasing. But the individual that controls the IRA is not on the hook for this loan. Now the reason that you don't see a lot of banks doing non-recourse loans is most banks typically like a personal guarantee. That's old school banking. It's basically built into everything they do. They look at the deal. If the deal works, then they look at the guarantor. If the guarantor is strong, then they lend the money. With a non-recourse loan, the bank just looks at the deal. They don't look at the guarantor because you as an individual don't guarantee the loan. It's all done through the retirement recorded version. My apologies. So anyways, what I was saying here with leveraging is that you can take your retirement plan, put up a down payment, and then finance the balance. What you're going to find is that most banks don't do this. Entrust keeps an unofficial list of banks that we know of that do non-recourse lending, and I can send you that list if you'd like. At the end of the presentation, I'll give you my email. Send me an email that basically states, send me non-recourse lenders, and I will shoot you that list. Now, we're not in any way affiliated with any of these banks. We don't have any kind of formal relationship with any of these banks, but we do try to keep a list because generally speaking, it's pretty hard to find banks that will do these types of loans. You can talk to your local community bank or privately held firm, and they may look at it, but when we find a lender that's active in that space, we try to keep a list of those folks so that when our clients ask, they can at least have a starting point on who to call on. And again, you can check with your local bank, but chances are they may not be interested in this type of deal. Key here is that the IRA owns 100% of the property. The IRA is just borrowing some money from an outside source to acquire that investment. So again, maybe the property is $200,000. The IRA puts up $100,000, borrows via non-recourse loan the remaining $100,000, and then buys that $200,000 investment property. That's the type of thing that we see with leveraged real estate through a retirement plan. One key point is that the IRA is responsible for the expenses related to the investment, which means the IRA has to pay back that mortgage. So obviously this doesn't work very well if you're going to buy a piece of dirt or some raw land, because if there's no money coming in from the investment, it's going to be a challenge to make that mortgage payment each month. So typically when you finance, you're looking at rental properties or commercial properties where there's flow of money coming in each month, which will then pay for the expense out each month of the rental of the mortgage payment. You can buy land through a retirement plan, but typically that's going to be done as a cash purchase, not as a finance purchase. With real estate being leveraged, typically you're talking about rental property. Next strategy is real estate options, and this is something that we plugged in here because we've seen some clients that don't have an absorbent amount of money but still understand real estate, that still want to do something real estate related with their retirement plan. And options kind of provide that flexibility of maybe taking a small amount of money and getting involved on a bigger investment. And with an option, typically what you do is you don't actually go out and buy the property and close on the real estate property itself. What you do is you negotiate to buy an option to purchase that property within a specific time period, typically at a predetermined price. So you can talk to the seller and say, okay, I will give you X amount of money. In return, you're going to give me an option to buy that property. Now, it may be that later on you exercise that option and then close on the property through the IRA. But one of the things that we've seen people do is sometimes that option itself will be sold to an unrelated individual. So you can go out and put in an option for real estate and then sell that option, and then the new person that purchases that option can actually close on the investment itself. And I've seen this, again, when the market was going really high in the early 2000s, we saw a lot more of this. When the market took a bit of a dip from 09 through 12, we didn't see as many options because they were a little bit harder to turn, just like any investment property is a little harder to get out of. With the uptick that we've seen in the real estate market recently, we're starting to see more options. We're seeing people that are signing contracts for value, or selling options for value. And it's something that if you understand that space and you've done that in the past, it might be something you could do through a retirement plan. So we talked about the basic way of owning real estate directly. We talked about doing it with split ownership, talked about financing, and then the way of doing it with options. And again, options are probably the least popular of the three strategies, just because options by themselves are kind of a unique structure. You either have done options and maybe you understand it, or you don't. I don't think the average person knows a whole lot about options, but it's something to consider. Go to your local real estate investment club and ask the experts there if they can tell you how to use options. Most of those folks that have been doing it a long time can provide some expertise in that and some information. So it's something to consider. The reason for the slide and reason why it's one of our strategies is we've seen clients do it. They like doing it. We allow them to do it. It works for a self-directed IRA. And if it's something you have a desire to do, it's something that we can assist with as the administrator. Doing your due diligence. Now this is important because with a self-directed IRA, the administrator, in this case Entrust, is not going to scrutinize the deal that you're getting into. We don't review the merit of the investment. We don't look at the investment and say, yes, that's a good deal, or no, that's not a good deal. That's not our position, and you will never find that from us because that's not the role that we play. That's something that you as a self-directed account holder are going to do on your own. And you're going to want to consult with the appropriate people to do that. Consult with a real estate professional, maybe an attorney, potentially maybe a tax advisor, depending on the situation. You want to make sure that you find somebody that's familiar with what you're trying to do. If you're looking to buy a piece of real estate through a retirement plan, you want to make sure that all the parties involved know that you're buying the real estate through the retirement plan. Know that the vesting is going to be a little bit unique. Know that the transaction is going to process through the IRA administration company, and set realistic time frames for everything that's going to transpire on the account and the investment. You're the one figuring out what you buy, who you buy from, what you buy for, who you rent to. That's all completely 100% controlled by you. If there's going to be a property manager or other people upkeeping the property, you're going to pick who that person is. If someone's going to put on a nice new roof, you're going to hire the roofing company. You're going to pick whatever roofing company you want to choose, and you're going to direct us to pay for the roofing expense from the IRA. We'll cut a check, but the key is you're finding the roofer or the plumber or the hardwood floor people or whatever you're having done related to your investment. We talked about the 3 easy steps. This slide gives a little more in depth on the time frame. Opening an Entrust account, depending on where you're located and which office you're working with, anywhere from 1 to 3 days. Our turnaround time, typically about 2 days to open up an account. And again, a lot of that comes into play with what documents are provided and what good working order and so forth. If we get the documents in good order, we're looking to open the account as quickly as we can because we know you're looking to get moving on the account, so we'll get it open as quickly as we can. Although keep in mind there are some things that we have to do on the back end. It's not just like flipping a switch. There's some stuff we have to do to open the account. It takes a little bit of time. Funding the account is really going to be determined from a time frame standpoint by your sending provider. If you have a good relationship with the company sending us the money and you tell them to speed it up, they're probably going to get it to us in a couple of days. If you're just sending paperwork into a company asking them to send us money, it could take anywhere from 10 to 14 days, and that's typically what we see. So the lesson here is to take away from is consider that when you're looking at the investment, make sure you understand how long it's going to take to get the money into that account, because you don't want a situation where the deal is ready to go and your money's not here. You want to gauge that into your timeline. Third step is to purchase an asset, 2 to 3 days depending on the investment. We can typically get the money out the door. I want to wrap up here. I'm going to have more questions at the end, but I want to introduce something that's brand new. We just rolled this out a couple of weeks ago, and I think it's going to be a very, very interesting addition to our industry and specifically to our company. And it's called the My Direction Visa Card. And basically it's about what you would expect from a Visa card. It's a card. It's a prepaid card that you can direct us to put money into to then go out and pay expenses related to your IRA investment. And I've been doing this for a long time, and I'm excited about this card because historically, if somebody wanted to pay an expense related to their account, to their IRA, they had 2 options. They could either hire a property management company and then direct a property management company to pay that expense, or they could come to Entrust and ask us to cut a check to pay for that expense, which we do, and we do in high volume. The downside of coming to us to get us to pay the expense is it takes a little bit of time. We have to print the check. We have to sign the check. We have to mail the check. All of that takes time and could take anywhere from 2 to 3 days to get out the door, and then you got 2 to 3 days in postage, and that can slow things down. If you want to pay somebody to do something related to your property, they may require money on the spot. Or if you need to buy some supplies from Home Depot, you'll need some money to buy those supplies. The My Direction Visa card is going to be very beneficial, I believe, in streamlining that process, because you can literally use it like you would use any other Visa card. You could go and pay for an expense related to your IRA-owned asset, and then you come back to us and you tell us electronically through the system what that expense was in relation to, and it codes almost exactly as if we would have cut a check and mailed it out to you. You're just eliminating the check time and the mail time, and it's hopefully going to speed things up quite a bit. What can it be used for? It can be used for almost anything. You could purchase an asset through your IRA. You could pay an expense related to your IRA. You could replace credit card paybacks for Lowe's and Home Depot, where in the past clients would sometimes have an account where they would bill up that account and then send us the bill and we'd pay it out to Home Depot or Lowe's. This is going to eliminate that whole step because you can use the card for all this. Tax liens, very time-sensitive investments, things that in the past we've had a little bit of struggle trying to figure out a way to allow clients to buy tax liens directly without utilizing an LLC. It wasn't very feasible. Now it is with the debit card. And then promissory notes and investments and things like that. The benefits is that it's fairly cheap. I think it's I should know this off the top of my head. I think it's $35 a year. Hopefully I said that correctly. But it's a one-time setup fee, and you got a minimum monthly fee, which I believe equates to $35 a year. It's extremely versatile. You've got a Visa logo on there, so if something happens, you've got support by Citibank. It's 24/7. So if you lose your card or if there's a fraudulent charge or something like that, you don't have to worry about calling Entrust to get that fixed. You can call Citibank directly and get it fixed with their 800 number. And again, it's unique and it gives you control. And the whole idea behind it is you know what you want to do, you know how you want to do it, you just want to get it done as quickly and simply as possible. We're hoping the card's going to help streamline that a little bit. So we've got information on our website now about the card. Again, Entrust is the only company that has this type of product in the market. It's exclusive to us, and we're the only company that has it. So if you're interested in doing it or looking into the details, let us know. We've got some great PDFs. We've got a little landing page on our site. Take a look at that, and I think it's going to be a great feature going forward for clients, specifically clients that want to buy real estate with their retirement money. I think it's going to be phenomenal for the market. I've got a couple of questions that have been typed in here. I know we've gone a little bit over on time, which unfortunately is typical because we tend to have a lot of questions and we go a little bit long. If you need to leave, I understand it's been about an hour. Feel free to just hang up, and this is a recorded presentation. We'll send you a link to the recording. It will also be loaded on our YouTube page so you can listen to the playback if you want at a later point. I'm going to take a few minutes and answer the questions that are in the system right now. If you have any questions that haven't been addressed or any issues that you'd like me to elaborate on, go ahead and type those in right now, and as I see them, I will read them and provide an answer and try to keep it fairly brief. All right, one question here is, if you paid for repairs, can you have the IRA reimburse you for the expense that you had out of your pocket? And the answer to that is no. You cannot pay for anything related to your IRA-owned asset personally. And you certainly cannot expect us to reimburse you for that, because then we would be documenting knowingly that you did something that you weren't supposed to do. The key thing with an IRA owning real estate is that the IRA owns the real estate. An IRA is its own standalone entity, and the IRA account is the owner of the investment, which means all expenses need to be paid for out of the IRA. Or if you do some kind of split ownership like we talked about before, maybe you own it 50-50, well then 50% of the expense needs to be paid out of the IRA. But you don't want a situation where your personal money is involved in something the IRA is taking part in. So no, you would not be able to pay for expenses and have us reimburse you for those expenses. Any money that comes from us to you has to be coded as a distribution. We cannot reimburse you for something, because by doing so, not only are we acknowledging that you broke the rules, but now we're partaking in it, and we can't do that, unfortunately. Hopefully the debit card, though, or the My Direction card, is going to streamline some of that and hopefully make that a non-issue going forward for our clients that want to pay expenses related to their investments. Another question is, if money isn't in the account yet and a property is found, can an unqualified money be used for a good faith deposit and then reimbursed from the IRA? The short answer to the question is technically yes, as long as that money is coming from an unrelated third-party person who's not a disqualified person. I can tell you from a transaction standpoint, it creates a little more complexity, and we prefer that it doesn't happen that way. We'd really prefer, and ideally in a perfect world, that the IRA is set up, the IRA has money, and if there's an expense related, whether it's an earnest deposit check or whatever, it's all done through the IRA account. That's really the way you should do it. Now, hypothetically, if there was a contract maybe out there that somebody completely unrelated put up an earnest deposit check up, and now your IRA wants to step into that investment, you could do that, and you could have the IRA reimburse that person and pay for that earnest deposit directly to the person, to the title company, or whomever, and then move forward. Again, not quite as clean, but technically is allowable as long as that person is not a disqualified person. If you're using your money or your children or your parents or your spouse, then you're talking about a prohibited transaction and the deal's dead in the water. But if it's somebody unrelated, it could work. Another question is, actually two questions, so it's clearly on your mind. What are our fees? We don't have a copy of our fee schedule up here. You can go to our website and download the fee schedule. We have two options for how you pay us fees. You can either pay us based on the value of your account, and there's this chart that basically calculates a fee based on the value, or you could pay us itemized per asset that you have with Entrust. The itemized option is $295 per asset per year. So if you had one investment on the itemized option, you'd pay $295 a year. If you had two investments, $295 times 2, etc. The value option is typically beneficial for somebody with either a smaller account or somebody that's very active. Let's say hypothetically you have 6 properties. Well, you may want to pay us $295 a year, but more than that, you probably want to look at the value option and pay us based on the value, because it'll probably work out to be cheaper than what $295 times 6 would end up being. And it's an either or. You look at that and decide what fits best for your situation, and that's how you pay us an annual admin fee. To open an account with Entrust is a one-time $50 account opening fee. To acquire an investment, the fee is either going to be $95 or $125. $95 is for anything non-real estate related. LLCs, private notes, private placements, it's $95. If you're going to buy into a piece of real estate because the real estate investment transaction process is more extensive, it'll be $125 instead of that $95. So, simple example, client wants to buy one piece of real estate. They set up an account with Entrust, pay us $50 to open the account. It's $125 to acquire it, and then $295 a year to hold it. Now there's a few little knick-knack fees that come in. If we cut a check, it's $5. If we get a wire, it's $30. Those are things you'll want to understand and kind of build into what you're planning on doing. But if you want to look at how we actually make our money, it's by holding assets for retirement plans and facilitating self-directed IRA transactions. We charge fees to do that. That's how Entrust makes money and grows our company. Another point there is my email is on the slide right now. That's a direct email, obviously, to my inbox. That phone number rings directly to my desk. If you have questions about any of this, or if you want to talk about your situation, or you want to get a copy of the application, the fee schedule, or a PDF on real estate investing, or a PDF on the My Direction card, just shoot me an email. And that's what I do all day, is I answer questions and help people through this process. So please use me as a resource, or if you want to go to the website and maybe find somebody geographically a little closer to where you live, you can use one of the other BDMs with the company and work with them as well. So we're here to help. We're here to do whatever we can to educate and get the information to you so that you can decide if it's a good fit for what you want to do. Here's a question: is can I make home repairs, use a credit card, purchase all the materials, absorb all the labor, but then use the card for the materials to avoid the cost of contracting? I'm not sure I totally understand that exact question, but I think what you're asking is, could you use a personal credit card to pay for all the expenses and then have us reimburse that credit card? The short answer to that is no, and the My Direction card is hopefully going to alleviate the desire to do that, because essentially that's what it is. It's a credit card related to your IRA that can pay for those expenses and so forth, to have a clear tracking, constructive receipt of everything that's transpired. But you don't want to take your credit card out and do that, because it could be a potential issue, and I won't go into it a lot in detail. But the My Direction card will hopefully answer all those questions for you. One last question. This gentleman brought up a pretty good point. I didn't address the question about checkbooks and how that works. There is a structure, and we didn't talk about it today because we have other information out there on a single member LLC, where somebody would utilize an LLC to make an investment and then appoint themselves manager of the LLC, and thereby have signing authority and checkbook authority over the LLC that their IRA is the owner of. What I would ask Brian in this case is just shoot me an email to phagen@theentrustgroup.com, and I will reply back with a list of frequently asked questions and a link to the PowerPoint presentation that we gave specifically on the single member LLC checkbook control structure. I could very easily spend an hour and a half talking exclusively about that topic. I chose not to today because I wanted to talk about some of the other unique things that our clients do. But our company does allow clients to do the single member LLCs if they elect to go that route. And it is a way that some of our clients take control of their money and have a little more accessibility to their money without the custodian or the administrator being engaged in what they do on each individual transaction. So if you have questions about that one information, shoot me an email. I kind of get the sense here as people are starting to log off that we've kind of gone long, and we have. So I'm going to go ahead and wrap it up. Again, my information's on the screen. Theentrustgroup.com is our website. We're here to help, and we've got information. If we can provide that information or answer any questions, we're happy to do it. I appreciate everybody taking an hour of their busy day to join us for the webinar. Hopefully it was valuable to you. We've recorded it. It'll probably be on our YouTube page as a recorded presentation. You can play it back if you like. If we can help in any way, let us know. Thank you so much for taking the time, and we will see you out here in the next webinar down the road. Thanks, everyone. Have a great afternoon.
Thank you. Please stand by.